Welcome to Mark Arnold's Finance. Something peculiar happened to the start of this week when it comes to the stock market, and we saw a lot of the stock market go to the green, but there was one sector in particular that didn't do so well, and that was the banking sector. So I want to talk about why it didn't do so well. I think this is a very valuable video because I learned some things I didn't know before, and I'm going to pass that on to you guys. So let's start with my portfolio performance. We will see here that I am down about 4.58%. That's about $2,300 of unrealized loss. And I want to take your attention down to Bank of America. This is the stock we're going to talk about today. It is up for me 30.5%. In fact, at one point, it was up over 70% for me. So I definitely got into this stock during the lows over the last 3 years, and it makes up 1.91% of my portfolio by market value. So this stock has done well for me, and many think that the interest rates are going to equal higher profits for banks, especially the big banks, but not so fast. After I did my research, I found that this may not be the case for this year in particular, and I want to explain why. So let's look at their stock chart. Over the last 5 years, this stock has not done too well. It's only up 8.66%. Now, its dividend yield right now is at a 2.6%, but my yield on cost with Bank of America is at a 3.39% because I got in at about the mid-20s, where now it's just shy of $34. So that's the power of getting in at a good point of a stock at a low valuation, at a low price point, is when it does go up, your yield on cost improves dramatically compared to its current yield. So analysts cut the stock price target of Bank of America from $45 to $36, and even JP Morgan from $155 to $145. So this definitely caught my attention. It got me worried, so I dug in to see what was going on. Now I want to mention both these banks report their earnings on January 13th, this Friday, so be sure to note that so you can see how they do, and I might post an update on my channel. Regardless, if they do well or not, the weakening economy is what analysts have their eyes on. Of course, analysts, the stock market, it's all future focused, just like we should be, and this is what is bringing some things to light. So even if the earnings are positive this Friday, we might get a short-term bump in the stock price, but analysts say that bank stocks could hit new lows in 2023, which is a big statement. So why the downgrade? Why are they citing that there's going to be weakening bank fundamentals and low stock prices in 2023? Well, it comes down to a few things. The first thing is something called net interest margin. Now, this is the thing I researched that I didn't really know much about, and I think this is going to be very valuable, so I'm going to talk about this one in a minute. But also, there's going to be loan growth slowdown, so with high interest rates, people aren't going to want to take out loans, and that means less money for the banks. There's rising credit costs. There's also cost pressures and limited excess capital to do share buybacks. And if you know anything about share buybacks, when companies do this, it helps prop their earnings up. Therefore, their stock price follows and goes up. And it's a good thing for us investors. So if they can't do that, that also signals a declining stock price, declining earnings. So let's go back to that net interest margin. This is something I researched, and I want to tell you what it is. It's a measurement comparing the net interest income a financial firm generates from credit products like loans and mortgages with the outgoing interest it pays holders of savings accounts and certificates of deposits, and it's expressed as a percentage. The net interest margin is a profitability indicator that approximates the likelihood of a bank or investment firm thriving over the long haul. This metric helps prospective investors determine whether or not to invest in a given financial service firm by providing visibility into the profitability of their interest income versus their interest expense. So it's basically the interest going in versus going out. And I dug on the internet and I was able to find some good information. So this is showing the past 12 quarters in the upper right there, and then at the very bottom over the past 10 years, the net interest margin performance of the whole banking sector. So we'll see here, there is a trend that when the pandemic hit and rates started falling, so did these margins. But now that the Fed is increasing the rates again, so are the bank's net interest margins. So I thought, okay, can we find maybe the top 5 banks and what they are currently? Yes, right now, Bank of America is right there on the number 2 spot. It's at a 2.36 net interest margin, and JP Morgan is actually less. So Bank of America actually does better here. And then you have Wells Fargo, Citibank, and US Bank all doing much better. And Citibank is the one that Warren Buffett invested heavily into, I believe. And I guarantee you this was part of his analysis before he did, and he probably liked that. So these net interest margins should continue to improve as the Federal Reserve lifts interest rates, but rising interest rates also provide many downfalls for the banks. And as we stated, customers may stop borrowing or borrowing less, which means less money for the banks to collect in interest. Also, a recession could make it harder for borrowers to make payments, which would equal defaults, which would hurt the financials of these banks. All this could hurt its stock price, its earnings. So analysts feel that bank earnings may be peaking this quarter, and then we will start to see a downward trend from here, especially if that recession finally gets announced or hits. So I want to show you guys the metrics of Bank of America. Of course, this is as of their last earnings, so I'll have to provide an updated one. But we'll see here their PE ratio currently sits at a 10.72, where their PE ratio over the last 5 years is 9.56. So it is above that 5-year average. I do think Bank of America is overvalued, and I would not be buying this until it hits that mid $20 range or below, shall we say below my cost basis. We'll see here the trailing 12 months of their cash flows is 28.01% growth. Very good and makes sense with the increase in the interest rates. Now the past 5 years is so-so at a 10.95, could be better. Their gross margins are exceptional at 88.57, and their total debt to assets is low at a 16.44, which is great. That means that this company isn't highly leveraged and can survive an economic downturn or a recession. So I will say this. Luckily, I have not bought any Bank of America since I first bought it in those mid $20 dollar range, and I will not buy unless if it hits that or below. So I think there's a strategy when it comes to banks because they tend to swing with the economy and really go down when there's a recession or economic downturn. I think those are the opportunities, which we might get, I feel, in the second half of this year. So when you are able to buy at those lows and get those better dividend yields, for myself at that 3.39%, I believe it was, that is creating some stability and a solid investment. Because I think if you're able to get in at those price points and be patient, you'll get a good yield, but also you should be in the green with your bank stock for probably 90% of the time until we hit the next recession or economic downturn. And that's just how I strategize with my bank stock. And that's what I plan on continuing to do. And I'm glad I was patient because though I'm up 30.5%, we've seen stocks, big quality companies fall 40, 50, 60%. Who's to say Bank of America can't? So that's my plan. I hope I can at least get there so I can triple what I have invested in Bank of America now because I really do like this investment. This bank ain't going nowhere. It'll be around probably the rest of my life, and I love that about this stock. So let me know what you thought. Did I introduce a new concept to you, the net interest margin, and will you be utilizing it? Do you think we'll start to see the earnings go down over the second half of the year after this earnings, which may be the peak? And would you be buying into bank stocks at that point? Or have you already, and why? I'd love to hear your bullish, your bearish theses on banks, Bank of America specifically, maybe JP Morgan, because that's another bank that's very popular and right up there with Bank of America in size and so on and so forth. So thank you guys for joining. I hope you learned something, and I hope you consider subscribing, and I hope you guys have a great day. We'll see you next time on Mark Arnold's Finance.